Hey everybody, welcome back to Dividend Stockpile. So today we've got a really exciting conversation for you all. We're going to be diving deep into business development companies, or BDCs, with someone who knows the space inside and out. So joining me is Kelly Green, editor of Dividend Digest and Yield Shark of our Mauldin Economics. So Kelly focuses on helping income investors find reliable, high-yield opportunities while managing the risks. And BDCs fall right into that. So in today's discussion, we're going to be talking about what BDCs are, how they generate high yields, what investors need to look out for, and which areas of the market look most interesting right now. So with that, Kelly, welcome to the channel.
Thanks for having me, Jeremy. I'm super excited. I love BDCs. So when you asked me to talk about them, I was like, yes, they're one of my favorite income investments.
That's awesome. As I was mentioning offline, I've never talked about BDCs here on the channel before, so I really appreciate you coming on and being willing to talk about it because it's a very big part of most income investors' choice of investments. And some people love BDCs, some people are scared of BDCs, some people don't know about BDCs. So having an expert that knows what they're talking about, come on, seems like the perfect fit. So before we get started into BDCs, can you just give a brief synopsis on your background and what you do over at Mauldin Economics?
Sure. So I have a degree in like mathematical economics, and I got a Series 7. Thought I wanted to kind of sell people investments, and then found out very quickly I like helping people instead of trying to generate money for my company through those investments. So I fell in love with writing about income stocks, and the really interesting part of income stocks and dividend stocks is that everybody thinks they're just for retirees and people who are older. Whereas I really fell in love with them because I figured out that I could build wealth and really set myself up for the future without investing a lot of time and without having to watch the market constantly, because these investments are kind of built to be safer.
Yeah, totally agree. And that's one of the main reasons I became an income investor as well, is I didn't want to have to worry about share price appreciation and not knowing when to buy, when to sell. And also, I don't have all day to sit there and watch the market like some of these day traders do. I can buy a quality dividend stock and hold on to it for 20 years and barely look at it, and it will still do just fine. Yeah. And we're getting paid income while we're holding it. So it totally makes sense. So awesome. So thank you for that background. Everyone definitely go check out Kelly's work. I'll put all the links and whatnot on the screen and in the description. But let's get into the BDCs. So business development companies, high level, elementary view. What is a BDC?
So BDCs are interesting because they're pass-through companies. So what that means is they were created by Congress for like some reason. So we have like REITs are the same with real estate, but BDCs were created so that the individual investor could have access to these middle companies, these mid-sized companies that were looking for investments. So we had these small and mid-sized companies that were really struggling to get investments in the 1980s, right? So, or late 70s, because these were created in 1980. So the thought was they could create BDCs, which would give the small and mid-sized companies more access to financing by letting individual investors get in on the market as well. And in turn, this would, boost the economy, create more jobs. So that's why they were created. Now, the pass-through aspect is a kind of incentive. So what happens is a BDC has to pass through 90% of its profit or its income through to its shareholders. In turn, it won't have to pay corporate taxes. So we prevent this double taxation, which means more money is going to the shareholders who will then pay the taxes instead of them paying the taxes and then the shareholders paying the taxes. So it's like this incentive.
So it sounds very similar to a REIT where they have to invest in a certain amount of properties, and the income from those properties has to be passed on to the investors of the REIT, and in order to qualify as a REIT, and in this case, a BDC. So BDCs were put in place to provide funding, basically, to small and medium businesses that may not be able to go to traditional banks, and they definitely can't access the equity markets and things like that. So it's kind of like the middle ground to help support those small and medium businesses.
Yeah, and the really cool thing about BDCs, which separates it from private equity, is so BDCs have to invest 70% in U.S. firms that have a market value of less than 250 million. So again, we're talking about those small to mid-sized businesses. But also a BDC is required to provide managerial support. So they're not just throwing money at the problem. They have to provide support to the management company.
So BDCs sound great. I mean, it's definitely a great niche in the market. I know a lot of people like REITs and things like that. So, I mean, this definitely fits in. What is the big benefit of BDCs to an income investor?
So for an income investor, because of the pass-through status, you get a higher dividend, which
Mm-hmm.
is great. And then it's kind of important to look at the difference between, private equity, kind of traditional private equity, and BDCs. So when you invest in like a private equity company as a public shareholder, you're investing in that company's ability to convince more people to give them more money to manage.
Okay.
So you're not actually getting the benefits of their portfolio and what they're investing in, right? The rich people who give them the millions of dollars for them to manage are who's benefiting there. You're getting kind of a piece of the management fees, and like I said, you're speculating on their ability to convince more wealthy people to give them more money to manage.
Okay.
And with a BDC, you're actually getting a share of the portfolio.
Hmm.
Um, it's so that's why it's really cool. And the reason that I really like them is, they have a higher dividend, but
Mm-hmm.
it allows us access to private companies and smaller companies. And if you when you look at a BDC, you always want to see what their objective is.
Mm-hmm.
So I personally like BDCs that give me access to markets that generally don't have dividends. So, like, my favorites are like life sciences or technology because those aren't companies that I can just go get on the market and get a dividend from because they are more speculative. They're smaller, they don't pay dividends.
Yeah.
So, I like that exposure to the portfolio.
No, that makes sense. And it's nice to get access to those types of companies, to your point, and a wrapper where you don't have to go invest in and go look into all these little companies. You're trusting the BDC to do that for you. So, how do BDCs make money? So, they're making these investments in these companies. Are they getting like a royalty? Do they get a percentage of the profits? Like, how does the structure usually look?
So, BDCs can use all sorts of methods. So, a lot of them are using senior loans. So you're getting the interest rate different there, whatever the BDC can borrow the money for versus what they can lend it for. So that's how they're kind of similar to traditional financing. But most of them also hold an equity stake, which makes sense because if you're going to provide management help, right, then you want it to grow. So the BDCs are making money from loans, they're making money from IPOs, they're making money from acquisitions of those smaller companies. So it's very similar to how other venture capital or private equity is making money. You're just
Got
kind of closer to the action here.
it. Okay. And do BDCs, rotate through the holdings? Or do they sell them at a certain point and go buy new ones? Or is it a long-term investment? Like, what does that usually look like?
They're usually very long term. I rarely see a BDC like selling a position or exiting a position. Generally, they're holding the loan and then they're also holding that equity position. So we don't really see them come out of the portfolio until they've done IPO or been acquired.
Okay. Nice. So there's a lot of benefits to BDCs. It's nice to get exposure to a different part of the market. When it comes to the yields, I know every BDC is a little different, but what type of yields are we talking about here?
So generally, when I am looking at a BDC, I want at least 9%. Occasionally, I'll
Okay.
go as low as 7. I love a double digit yield. I mean, who doesn't, right? We don't get those very much, like safely. But right now, we're in a position where BDCs are kind of like hated by the market, which it makes sense. We can go into that. But BDCs are very much kind of beaten down right now. So there is that opportunity to get that 9, 10, 11,
Mm.
12% yield on some of these.
Yeah, so it's just like individual dividend stocks. If there's news that makes the price go down, or the cyclicality of the market's not favoring a particular industry, those are the times where you buy in to get the good yields and hopefully capital appreciation in the future. So with that, I guess there are some risks associated with a BDC that might be different than some other investments you guys people can make. So what would you say the top risks of investing in BDCs? What does that look like?
So the good part about BDCs is again because the company is involved in the management. There's not a lot of risk of like one company taking out the whole portfolio.
Hmm.
And that's always something when you buy a BDC, you should look. It's the same with a REIT, right? You want to look and see if their largest position is, over 15% of the portfolio. That might be a red flag. Maybe it's not a red flag, depending on what that holding is. But you want to see what kind of the top 10 holdings are. And if something happens to those, is it going to drag the whole portfolio down?
Yeah.
So it's definitely important to make sure that there's not shadiness going on in the management of the BDC.
Okay.
So I've never been bitten by a BDC before, but I've been bitten by a REIT before,
Hmm. Right.
um, where we were holding it, and then all of a sudden you were like, this management team is saying one thing and doing another. Well, that's going to bite us. Um,
So,
so, yeah.
sorry.
So you got to check that.
Yeah, as with any investment, you need to know what's going on under the hood. When it comes to their holdings, is it usually pretty diverse within each BDC, or do they focus on certain areas? Are they concentrated? What does that typically look like?
It varies, obviously. Same with REITs. So that's the thing. They're very similar to REITs if you're
Hmm.
familiar. But that's something. So it's funny whenever I tell somebody to look at like an ETF, I always tell them to look at the top 10 holdings, the objective, and the management fee.
Yeah.
Very similar for REITs, right? Very similar for BDCs. To get a good, quick overview of what they're doing, right? What is their top 10 holdings? Does it fit in line with their objective? Does it make sense?
Hmm.
Um, so yeah, again, like I said, I personally like to look for like tech and life sciences, and I generally prefer REITs that are very heavy in those industries. I tend to kind of stay away from ones that have a lot of like consumer discretionary goods these days. In
Hmm.
the past, I really liked like Compass Diversified Holdings was one of my favorite like 10 years ago. It was interesting because they had like a big gun safe company. So
Mm.
like 10 years ago, everybody was like investing in guns, and I was like, I want a safe company. So I used BDCs to get that exposure.
Yeah,
But nowadays, I really want that tech and that life sciences exposure.
gotcha. And so, how do interest rates affect BDCs? Are they similar to the REITs, where the higher the yield, the worse BDCs tend to do, or how does that work?
So that question kind of sets me up to talk about like why now for
Okay,
BDCs.
go
So
for it.
BDCs are having this kind of moment where mid-size and small companies are just like the whole economy. Everybody's trying to like shore up their balance sheet right now, right? They're
Mhm.
not trying to take additional funding for no reason. So, when lending is when it's easy to get cheap money, right? Interest rates are low. Companies are going to take out loans that they might not necessarily need because money's so cheap. And we're
Mhm.
not in that situation right now. So BDCs are seeing people pay off their debts, and even prepayments are higher than usual, but they're not seeing the originations because people aren't trying to, get money at these higher interest rates. That makes the NAV go down, the net asset value, and
Mhm.
BDCs trade generally around their net asset value.
Okay.
So we're seeing the net asset value go down because it makes sense. More prepayments, less originations.
Yeah.
And that's not a bad thing. It's just a thing, right?
Mhm.
Because what's going to happen as we see interest rates go down is these companies, they've shored up their balance sheet. They've kind of put off expansion. They've put off the acquisitions because of the uncertainty in the economy. But as
Yeah.
money becomes cheaper, they're going to say, oh, well, let's do it now.
Yeah. And I think their overall expectation is for rates in here in the U.S. to go down, 1 or 2% over the next year or so. So it should be in a much better position where a lot of companies are finally willing and able to get those loans and to expand and things like that you were mentioning. So that can only help BDCs at that point. But like you mentioned at the beginning, the time to buy it is when the market doesn't like them, and so you can invest. And hopefully, 2 years, 5 years down the road, you'll be in a much better position once the cycle turns around a little bit.
Yeah, I kind of joke that my short-term positions are still like, 2 to 4 years,
Nice.
but I really do think BDCs, the next kind of 3, 4, 5 months is the time to buy because 2026, once we see the interest rate drop start to trickle into the economy, even
Hmm.
if the NAV hasn't changed, people are going to realize that the lending is going to kind of increase. So now is the time to buy. And I don't even think we're going to have to hold 2 years to really see the share price, appreciation, because the NAV is going to change, fairly quickly once that lending starts.
Yeah. And in the meantime, you're getting a great yield, in some cases, double-digit yield while you wait. So sounds like a pretty good package to me. All right. So just like in a REIT, like if they have a bad property and something goes wrong with that property, it could affect the REIT itself. I'm assuming it's similar with BDCs. What happens if one of their invested companies goes bankrupt or has some financial difficulties? How does it affect the BDC itself?
I mean, obviously, you're going to see the change in the NAV, right? You're going to see. Generally, I don't see BDCs, at least the ones that I recommend, really lowering their dividend because of a bad property, or sorry, a bad company. But it's more because I don't want a company that has like very few holdings, and they're holding a large part of the portfolio. And again, it's the quality of the management. If the management team is doing their due diligence, I mean, off camera, we were kind of talking about First Brands,
Yeah.
and that seemed to affect a lot of BDCs. But the weird part is, you look at First Brands, and they were just taking out more debt to make acquisitions, and like that was not like equating to more earnings. So it was just this kind of like dark hole of money. And then all of a sudden, earlier this month, now they're under investigation for like, 2.3 or $2.5 billion just like vanishing.
Yep.
And then I love talking about the auto industry as well. Like they do aftermarket parts, and that's, oil filters and things. And that's a weird kind of realm right now too, because with cars becoming more, computers, it's harder for you to work on them. So so there's a lot of things going on that makes me want to say, well, the management teams of these BDCs, like what were you doing?
Yeah.
You didn't see the writing on the wall? Like,
Exactly. Or did the right due diligence or position sizing and all these other things if you're too exposed to that market without doing your research. So yeah, so picking out the BDCs based on, to your point earlier, management, holdings, things like that, industries they're involved with, can go a long way. So I guess with that, since you kind of talked about what you like, what are some BDCs that you do like right now that some people can at least get their research started? Not a recommendation, but kind of what's on your radar right now?
So I'll give you guys like two that are kind of different. So you have Ares Capital Corp, which is ticker ARCC, is one of like the top BDCs by holdings. And they're kind of like an all-around BDC. They have a lot of exposure to a lot of different geographic locations, to a lot of different industries. Now, that being said, 23.5% of their portfolio is software and services. And, I do like tech. And then like 9%, like 50, I think it's 15% is healthcare equipment. So their top two industry holdings are software and healthcare, which I like. Their dividend right now is around 9%. So they're a good kind of like all around.
What was your other one you were thinking of?
Okay, so this one's been one of my favorites for 14 years, right? I've been in and out of it. So they're now Hercules Capital, ticker HTGC. That always tells you how long I've been doing this, when I have to be like, they've changed their name a little bit. I have to make sure I tell you the right thing. But Hercules is one of those BDCs that they're very focused on technology and life sciences. That's their two main things. It's again one of my favorites. Its current yield, let me look. Their current yield right now is 10.9%. They're trading around $17.28. So that's also very affordable if you want to add shares. I mean, that's the other part of investing, is sometimes the things you want to invest in are a couple $100s, and Hercules is a good way to like get started in income investing too. Nice. I like shares up to $19.20. I'll give you like a sneak peek of what I do, right, in my premium investment service, right? So I like Hercules, and then I always say like I like it up to $19.20. So yeah, that's one of my favorites.
Okay, and I know I don't invest in it personally, but I know a really popular one out in the community is Main Street, so MAIN. You have any insights on that one or opinion on that one?
Yeah, so I mean, Main Street Capital is, again, they have a very kind of like wide overreach. And if you look at their objective, they're just kind of looking to make money, right? Which it does not a bad thing, right? They're just looking to make money, but it doesn't seem like they have a clear objective on what their specialty is. They're just kind of looking for opportunities all willy-nilly. And I like those BDCs that focus on something specific because the management team is going to know that type of
Mhm.
company. And their dividends, 5.2, which I'm such a yield snob these days. So it's not enough yield for me to like take a ride with a BDC.
Yeah, that makes sense. And I think Maine itself has gone up quite a lot over the last few years, so that might be one reason why the yield is so low right now. So yeah, so BDCs, it's a great investment for income investors that provide you some diversity from your traditional income investments. You gave us some ideas of some ones that are on your radar right now, but I want to talk about more of like what you do in your everyday job. So I know you're the editor at Mauldin Economics, and you run 2 newsletters. So can you talk to everyone about that a little bit?
Sure. So I have a free newsletter every Wednesday called Dividend Digest. The easiest way to find that is Mauldin Economics Dividend Digest. And then I also, for you that like video content, clearly, I do kind of a video version of that every week on my YouTube channel. So that's kind of the free content that I have. And then I also have a premium newsletter called Yield Shark. Um, and what I do there is I give my favorite stocks. So we have our portfolio divided into 2 pieces. We have Bedrock Income, which are the stocks that I feel like you could hold for decades. You could pass down to your children, your grandchildren, in my case, my nephews. And these are ones that I recommend you reinvesting the dividends and just build that wealth. We also have current income stocks, which are those higher yields. We may only hold them, short term, 2 to 4 years. They might pop and we might get out. I sometimes I do some special situations, which are like a speculation on something, but there is also a dividend. So our kind of primary goal there is that we think there's going to be that share price change. And then in the last couple months, we've also introduced covered calls. So I kind of do some hand holding for covered calls if people are interested in that, which is really unique in kind of a newsletter of this price point. It's a way lower price point than you'll find most options newsletters. So that's kind of what I do on the regular there.
No, it's awesome to be able to talk to someone whose day job and what they do 40 plus hours a week is income investing. It's such a nice thing to hear from someone that does this on a day-to-day basis, not just some amateur investor like most of us out there. Like you guys, you're actually in this world and doing the research, and you have all the models and everything else that you guys go by. So definitely everyone go check out Kelly's work over there. I'll put all the links on the description and in the video as well to make sure. Definitely take a look at, absolutely sign up for the free newsletter, and definitely take a look at the premium newsletter to see if it's something that fits what you're looking for. So I'd love to ask if you could give like an elevator speech on why BDCs, why income investors should want BDCs. What would you say to someone really quick?
Really quick, why BDCs? Because who doesn't want high yield, right? BDCs they're my favorite way to get higher yield, as long as you can find one with a high quality management. And it also gives you access to those companies. Like you can't get the access to those smaller companies, to the tech companies, unless you're a venture capitalist. So if you've got a couple $1,000,000 laying around, just ignore me. Go invest in those companies. But like if you want something at a $20 price point, this is a great way.
Yeah, it's a great way for the average investor to get access to these types of investments. So that sounds awesome. Kelly, really appreciate your time. Thank you so much for coming on, and hopefully we'll be able to chat soon.
Perfect. Thank you.
Thank you. Thanks for watching. While you're here, check out this next video to learn more about dividends, income investing, and option selling. And while you're here, make sure you subscribe. Click the like button. It really does help. Thanks.